For decades, private equity was a closed ecosystem. It required minimum commitments of $5 to $10 million and kept that money locked away for 10 years or more. But now, that monolithic vault is swinging wide open, and Wall Street is finally ushering in the middle class. They market this as the democratization of finance. The pitch is compelling, giving everyday retail investors a pass to the steady income and high yields that were once reserved strictly for pension funds and billionaires. But top banking executives are watching this shift with concern. They are warning that funneling complex, illiquid private debt into retail portfolios carries risks that have historically preceded systemic financial crises. This invitation to the public represents a massive shift in how these funds find capital. To see what is driving this sudden inclusive spirit, we have to look at the vacuum forming in the institutional world. The catalyst for this move began in 2022, driven by a mechanical flaw in institutional portfolios known as the denominator effect. When public stock markets crashed, private market funds kept their internal valuations artificially high. This chart shows how that dynamic breaks a portfolio. As the public equity slice shrinks in real time, the private market slice appears much larger, breaching strict internal policy limits. Endowments and massive pension funds suddenly found themselves dangerously overallocated. To rebalance, they completely stopped writing new checks to private fund managers. That abrupt freeze created a vacuum. A $2 trillion industry, built on an endless cycle of raising larger and larger funds, was suddenly starving for cash to keep operating. The push to democratize private markets serves as a capital substitution strategy. Asset managers are using everyday retail wealth to plug the massive hole left by fleeing institutional money. To tap into retail dent accounts, asset managers had to engineer new delivery mechanisms. They created business development companies and interval funds, wrappers designed to make complex private loans look like standard, accessible mutual funds. The defining feature of these products is the promise of liquidity. Retail buyers are told they can withdraw their money on a quarterly or sometimes monthly basis. They are also sold on stability, relying on an accounting practice called volatility smoothing. Public stocks reprice every second, reflecting real-time chaos. Private funds use delayed appraisals. Management draws a deceptively smooth, straight line through the turbulence. Academic research exposes this trick. Adjusted for these delays, true economic volatility spikes closer to 30%. Retail investors are being lured by a mirage. The reported stability hides the actual risks hiding directly underneath the surface. That mirage sets up a mechanical flaw engineered right into the core of these semi-liquid funds, an extreme asset-liability mismatch. The promise of fluid quarterly cash withdrawals violently grinds against the reality of the portfolio. The money is locked inside 10-year corporate loans that cannot be sold off quickly to pay exiting investors. Retail buyers also suffer from adverse selection. Because the top-tier private equity firms reserve their best deals for major institutions, retail-focused funds often end up absorbing the opportunities that the elite players passed over. Adding to the burden, this access is expensive. The retail wrappers come heavily burdened with multi-layered fee structures that create a severe drag on actual realized returns. Everyday investors are taking on institutional-grade risk and paying higher fees to do it, while lacking the negotiating power to secure basic protections. Between 2025 and 2026, the theoretical risks of this expansion began to materialize. Rising corporate borrowing costs and volatility in the public markets created a wave of anxiety among these new retail participants. Individual investors reacted to the news and rushed for the exits. They demanded their cash back simultaneously, overwhelming the redemption caps of these semi-liquid funds. This chart demonstrates the collapse of Starwood Real Estate Income Trust. In just over a year, liquid asset reserves plummeted, dropping from $2.2 billion down to just $752 million. To prevent a catastrophic fire sale, management slammed shut the exits. They slashed monthly buyback limits to a tiny fraction of a percent. Contagion spread rapidly. The stock prices of the asset managers fell sharply, and millions of retail investors realized their savings were now trapped inside these funds. These liquidity gates function as a structural firewall. When redemption requests outpace cash reserves, the mechanism freezes retail wealth in place, shielding the fund's underlying assets from a forced liquidation. Navigating this landscape requires immediate defense mechanisms. The first step is to calculate your exact percentage exposure to gated private credit funds, separating what is truly liquid from what is locked away. You have to read the form CRS disclosures down to the fine print. Demand transparent pricing models from your advisor that strip away the smoothing tricks and reveal the true historical volatility of the underlying loans. Semi-liquid is a marketing term. In practice, it means the asset flows easily when the markets are calm and turns solid the exact moment you actually need the cash. If you sit down at a complex financial table and you cannot figure out who the exit liquidity is supposed to be, it's you.